Welcome back, students, to our series of second lecture. Yes, sorry for a little delay. Yes, welcome back. This is where we stopped at slide number 9, where we prepare the net cash flow for example number 5.1. So we are continuing from that slide. Now we'll look at one small exercise which is similar to what we have studied in example 5.1. Now in this question, if you can read it carefully, it says that a business at your design engineering firm has been brisk. Brisk means their business was quick or fast, or it was growing. And what this company is doing, they are doing some design engineering to keep up with increased workload. You are considering the purchase of new state-of-the-art CAD or CAM system costing 500,000, and that would provide 5,000 hours of productive time per year. So now you are going to purchase a new CAD or CAM system. The CAD stands for Computer Automated Design, and CAM stand for Computer Assisted Manufacturing Systems. These are maybe you are especially those who are in mechanical engineering, they must be familiar with these terms about CAD and CAM. So this company, in order to cope with the increased workload, they are considering to purchase this system which costs them 500,000 and which provides 5,000 hours of productive work. Now your firm has put a lot of effort into drawing new product design. Now at present this design activity is all done by design engineer on an old CAD and CAM system which was installed 5 years ago. Now this is the existing scenario. You are doing it on the old machine, and which you would like to replace with the new state-of-the-art CAD CAM system. If you purchase the system, 40% of the productive time will be devoted to drawing, which is CAD, computer assisted drawing, and the remainder to CAM. While drawing, the system is expected to outproduce the old system by a factor of 3 to 1. You estimate that additional annual out of the pocket cost of maintaining the new CAD and CAM system will be 175,000, including any tax effects. So this will be annual maintenance expenses. Remember this one, very important information. This one, the expected useful life of the system is 8 years. So we are going to use this system for 8 years, and after 8 years it will have no salvage value or no residual value. It is the same meaning as salvage value, means that after its useful life you have to just throw it out. In simple word, it has no value, you cannot sell it. As an alternative, now this is one option, either to purchase this new machine, or you can hire more design engineers, right? So each normally work 2,000 hours per year, and 60% of their time is productive. Total cost for a design engineer is $40 per hour. Remember, this is important information. There are 5 design engineers. So if we are going to purchase the machine, then we will not hire these engineers, meaning we will save this labor cost. Now the question is, identify the net cash flows associated with drawing activities if the CAD CAM system is purchased instead of hiring more engineers. Remember, this machine is used for both functions, CAD and CAM, but the question here only says which is related to drawing activities. So just to make a question simple, we know that this new system will be used both for design and for manufacturing, but Here we are going to quantify the information only for drawing activities. I just put here the same information in more user friendly way. You can see here the CAD and CAM system, the cost is 500,000, or it has 5,000 of productive time. It will be used for both CAD and CAM system. 40% for CAD and 60% for CAM it will be used. What is the benefit and cost of purchasing? This is the question first, right? That what is the net cash flow, or what is the benefits and cost of purchasing this system? Now, what are the benefits? If you can pause and think about it. Yes, the cost of a system is 500,000. Then you have an annual maintenance cost as well, and only benefit which we are going to get is you will have a labor savings, right? So what is the savings in labor? We'll see it on the next slide. Now, labor saving is $45 for one per hour cost of a labor which we will save, and this is the total times of labor. Is a 5,000 is a total capacity of that machine. 40% for CAD times 5 engineers, so the total cost or the cost saving will be 450,000 per year based on 5 engineers. This is what we will save. If we are going to purchase new machine, we will not going to hire these engineers. We are going to save this cost. So saving cost is same as a revenue or a benefit, because it will increase your profit or revenue. Now, putting the same information into a tabular form, you can see here that we have first column is years from 0 to 8. Inflows are 450,000 which we just calculated above, and outflow is year 0 is 500,000, and 175,000 is the cost of the annual maintenance annual cost, which you can see here. That annual maintenance cost, this 175,000 is given in a question. So our net cash flows are 450 minus 175, 275,000. So if you continue it, that's it. So this is basically answer to exercise 5.1. What I suggest you is to do it again for your own understanding. Just solve it again, the same, because we are going to use this exercise in some other questions as well later on. Question number 5.2 is also similar to 5.1. I'll read it here, that the Camptown Togs, a children's clothing manufacturer, has always found payroll processing to be costly because it must be done by a clerk. The number of piece goods coupon received by each employee is collected, and types of the task performed by each employee are calculated. So this company, they are cloth manufacturer, and payroll processing means giving salaries to those employees who work on these clothes is done manually before, right? So now an industrial engineer not long ago designed a system that partially automate the process by means of a scanner that reads the piece goods coupon. So there were coupons attached with each piece of cloth, and when some employees work with it, they scan it, and that will help them to know how much time has spent on each cloth. So with this system, it was this system is available to management, and they want to implement it. Management is enthusiastic about this system because it utilizes some personal computer system that were purchased recently. so they don't have to do any additional investment. It is expected that this new system will save $45,000 per year in a labor cost. So this is their saving if they purchase this new system. What is the cost of new system? The new system will cost $30,000 to build and test prior to operation. This is the cost in year 0, and this is the saving every year. It is expected that the operating cost including income taxes will be $5,000 per year. So now this is an annual cost, this one is a one-time cost, and this is per year saving. Now system will have a 5-year useful life, and expected net salvage value after 5 years means that you will get this 3,000. When the system becomes obsolete, you can sell it to someone and get 3,000. Now the question here, identify the net cash inflows, means what are the benefits, what are the cash outflows, means cost or expenses, and what is the net cash flow. It's similar to the previous question. Cash inflows are saving in labors, which is 45,000 per year. Salvage value is 3,000 at year 5. Cash flows, outflows are capital expenditure in year 0, which is this one, or in a table it is like this one. Operating costs are 5,000 per year. So estimating project cash flows together, this is the answer of part C: inflows, outflows, and net flows, which is inflow minus outflows. So this is the cash flow cycle. Before, remember in chapter 3 and 4, this net cash flows were given to us, but here now we, in a real life scenario, we have to calculate the cash flows by our own. I hope it's clear. Again, try to practice. This will be easy, inshallah. Now, in this chapter also we are looking at a project screening methods. What are the project and what are independent and mutually exclusive projects? In our life, we have independent projects, means if you select one project, it has no effect on accepting or rejecting the other project. These are what we call it in statistics, right? That they are independent projects. Maybe you have studied in statistics about independent variables in probability. It has the same concept, right? Now in a real life, for example, if you want to purchase a CNC machine, and also we want to purchase a car for sales department, these are two separate situations, and they are not dependent on each other. But sometimes in a real life situation, we have dependent projects as well. For example, let's say we want to purchase a CNC machine, but in order to operate it, you need to have a maintenance contracts from the same supplier as well separately. So you have two projects separately, one for the purchase of machine and one separate contract for maintenance and troubleshooting. Now, for example, if you are not purchasing a machine, then of course you will not purchase the maintenance contract. So these both projects are dependent on each other. Mutually exclusive projects are when one project is accepted, other will be rejected. For example, you have to decide between purchasing laptops or desktop computers. You have to choose one. If you choose laptop, then obviously desktop computer purchasing will be rejected. So you have to choose one. This is what we call it mutually exclusive projects. This is just an important information for your theory. This is also given in your book in chapter number 5. Just review this information from the book as well. Now, important thing is the project screening methods here, which are also very important tools to analyze and decide about a project life. Now, first method of a project screening. What is a project? As we explained, it could be an independent project or it could be an mutually exclusive projects. Now, there are different methods. First method is payback method, second is net present worth method, third is net future worth method, and the last one is capitalized equivalent method. Under payback method, we have two methods, conventional payback and discounted payback method. These are important concepts. I will explain them by solving some of the questions, then you will have a more and clear understanding. Payback period method, it basically tells us that how fast can we recover our initial investment. It is based on cumulative total cash flows, that how much cash we have received against our investment. For example, let's say we invested some amount and we want to see how long will it take to recover it. Now, one project says that if you invest some amount, you will recover it in 5 years. Another project says that okay, we will recover the amount in 3 years. Whatever we invest, we will recover that money in 3 years. So one has 5 years payback period, another one is 3 years. Which one to select out of these two? It depends on the screening guidelines. What is screening guideline? Is that you have so many different ideas by different engineers. Companies will not implement all ideas. If you are a decision maker, you have to choose between different projects. So one way is, the quick way is to look at the payback period. So you can compare it with your benchmark. Let's say the management has decided that we will only accept the project whose payback period is 2 years. So we will not accept any project where payback period is more than 2 years. So quickly you receive an idea from an engineer. Your first question, okay, what is the payback period? They said, okay, 5 years. Okay, rejected because it not meet our guideline. Right? This is an easy way to screen the project. Right? A simple example is sometimes when a company hires the students, they say, okay, they receive thousands of applicants. They say, okay, anyone having less than 3 GPA will be rejected. So that's how a screening guideline helps. Same thing for projects. So you have a benchmark payback period. For that one, you can accept or reject any project. Now, is it the best method? Of course, it is easy to use, but it has some weakness. Here, we does not consider the time value of money in this method. Now, the same example, I will continue. Example number 5.2, a conventional payback period for the same example, which we have already solved, which is in front of you. Now, in this example, you can see here that we have an equal cash flow, net cash flow, which was positive. So, how to calculate a payback period? If you look at bottom of your screen here, this one is the formula to calculate a payback period. Initial cost, which is 650,000 divided by the uniform annual benefit, which is 162,500. So it's 4 years. So if I look at up here, so you can say here that 162 plus this plus this plus this. By this time we will recover our, if you add all of them, you can say, okay, I will recover my investment in 4 years. So my payback period is 4 years. Now, one of the weakness of this method is that we consider these cash flows all equal, which is not true as per the time value of money. The time value of money says, which is a very important principle in engineering economics, that these cash flows are not same because they occur at the same time. We cannot just simply add them and make a decision. So this is one of the weakness, but again it is simple to use, so that's why it is there in the field, and still practically people are using it to make decisions. Now we'll continue with another method. When, remember the difference between 5.2 and 5.3 example, it's very important to keep in mind the difference between 5.2 keep in mind here what is the cash flow and what will be the cash flow for this example. Conventional payback period with the salvage value. Ato Numerics company has just bought a new spindle machine at a cost of 105,000 to replace a one that had a salvage value of 20,000. Now understand this example very carefully, this information, because this is an important question for your exam as well. Now what is the cost of a machine? 105,000. This is the cost of a new machine. Also they had one old machine which they will sell it now to buy this one. So when you sell old machine, you get 20,000 as well. If so, how much will be your net cash flows in year 0? It will be this much you are spending plus this is the money you will get from old machine. Very important information. Projected annual after tax saving via improved efficiency which will exceed this investment cost are as follows, which are given. Also you can see it on page number 241. This example is there. So what is the conventional payback period? Now if you look at here, this is the same information given in the previous question example, or if you want to read it, it is on page 241. In year 0, what is the net cash flow is minus 105,000 to purchase a new machine plus you sell an old machine at this price. It is same like when you go and sell your old car and purchase a new car. So our initial cost will be in year 0 will not be 105, will be minus 125,000 plus 20,000. How much it will be? 85,000 will be our cumulative cash flows, and these are the benefits which we will get it. These are givens in year 1, year 2, year 3, 4, 5, 6. These are the cash flows which are given. We don't have to calculate. Now what is the difference between the previous example 5.2 and this one? That in previous example these cash flows were equal. It was an equal cash flow, but for this question it is an unequal cash flow series. If you have an equal cash flow series, it is very easy. You just divide uniform cash flows by the initial cost and you can get the time period. But here you have to calculate manually one by one. First our cumulative cash flow, which is 85,000 negative. Then how much is left? See, this is our investment or the amount of money which we have recovered. Now how much we have recovered out of 85 is 15,000 in year 1. Very important. So how much investment is left still to cover? You invested 85,000, means it was negative. And this one is gone, so how much we are left? Minus 85 plus 15,000 is how much? Yes, you are right. Minus 70,000. Now minus 70,000 is left. After minus 70,000 left in year 1, next year we received 25,000. Now again you add minus 70 plus 25,000 minus 45. So we continue like this one until we reach a number where we get a positive number. Remember when to use this formula? When you have an unequal cash flows. So if I continue with the same method, I can see here, okay, it is my I will recover my investment in year 3 and 4. Now it becoming positive. So it means my payback period is between 3 and 4 years. Okay, I don't need to continue, but just for your information, let's say we continue. So you can see here by year 6 we'll have a positive 115,000 cumulative cash flow from this project. But my point here is to calculate a payback period which is between 3 and 4 years. This is the payback period between 3 and 4 years. Exactly how much it is? It will 3 years plus, you can see here how to know. It is between 3 years plus how much was left without taking minus. Remember, no need to consider minus. We were supposed to recover 10,000 in next year, but we recovered how much? 45,000. This one, this number. Don't confuse with year 5, only this one. By chance their 4 and 5 are same. So as per the rule, the next year cash flow. So minus 10,000 plus this 45 divided by 45, this is give you a fraction of that amount which was recovered after third year. So if you solve this equation, it will be 3.2 years. So our payback period for this project is 3.2 years. Now this company will recover their initial investment in 3.2 years. Now this is again a simple method to calculate a time. How long? This will only tell us about our time. So after 3.2 years, we are not considering how much you have it after 6 is 115,000. No, we are not looking at monetary value here. We are not considering the value of money after payback period. And this is also one of the disadvantage or the weakness of this system, that it does not consider the cash flows which occur after payback period for decision making. But again, is it a good decision whether to accept this project, reject this project? Again, it depends on our benchmark. What is the benchmark? If the benchmark is 5 years, for example, that this company says we will accept all projects if they recover our investment in 5 years. Fine. Then this project is fine. 3.2 years is correct. You say we must accept this project. But if benchmark is 2 years, they say no, we will not accept this project because we will recover our investment in more than 2 years. So it is going to be rejected by the management straight away. Okay, it's clear. Just try to have more practice. Now, in a previous method, we have seen that it does not consider the time value of money. Now, if we have a slight change in a payback period method, we call it discounted payback period method. That how long will I recover my investment plus the time value, which is the interest. Now, this method is again based on total discounted cash flows. If same guideline, if discounted payback period is less than or equal to some specified benchmark period, project could be considered for further analysis. But again, one of the weakness is that any cash flows which occurs after discounted payback period method are ignored. So I'll explain the same example with this method. Let's say in a same question, same example, what if the interest rate is 15%? What will happen? If the interest rate is 15%, right, it is given on table 5.2 on page number 244. The only difference is this column. Just look at here. Initial cash flow is same from the previous one, minus 105,000 plus 20,000, that one, the same amount. Cost of fund means how much is the cost of fund, the time value of money which we must recover, the cost of the funds. So we must not recover this money, also the time value of the money as well, meaning that in next year, after 1 year, you must recover 85,000 as well as cost of the money which was invested on this project, or in other words, the profit which we could have generated by investing on some other project and increase and get a profit of 15%. So how we are going to calculate it? 15,000 cash flow minus this one, or cost of fund, minus previous year balance 85,000. So if you add it, minus 82,750. This is the amount we still we need to recover. Now next year we recovered 25,000. So how much is left of our investment is minus 70,163. How much? How we calculated? Same method. which is 25 minus 12,413 minus previous balance, you get minus 70,000. So we continue with the same method until we get positive amount. So here you can see that the discounted payback period is between 4 and 5 years. It is between 4 and 5 years. Exactly how much it is, again you use the same method. It should be how much we are supposed to recover, this amount divided by this 45,000, this amount, right? So this one will be calculated. Similarly, exercise 5.27, I am not solving it. You can look at it and try to solve it with the same method, right, and see how you understood this topic or not. I am going to end my lecture, and I am giving you some practice questions to solve it, and if you have any issue you can send me an email. Also you can practice this question as well, question 5.6, to calculate a payback period. Very important to calculate this payback period. I am stopping here at this slide number 24 and 23. Part A and Part B are both payback periods, so spend your time before we continue to slide number 25. Next time I will share it, and now I'm going to stop my video. Hope you understand this lecture. So we'll see later on. If you have any question, we'll discuss more, but again very important, please practice these questions. Very important for your final exams and assignment as well. Thank you very much.